Welcome, everyone. I'm Pat Soldano, President of Family Enterprise USA. We advocate for generationally owned family businesses and their lifetime of savings at a national level in Washington, D.C. We represent all sizes of business and all industries. We really appreciate your participation in this webcast today. Today's topic is valuing a minority block of stock when a private company is for sale. And I'm very pleased to have with me today Mark Lingerfield, who is a partner and managing director of MPI and has been based in the firm's Princeton office for 25 years. He is responsible for client service and business development strategies in the Mid-Atlantic region. Welcome, Mark.
Thanks, Pat.
Mark will discuss the IRS Chief Counsel's advice memorandum concerning the valuation of a private operating company in an estate planning context, when company management has begun the process of selling the underlying company. He will discuss a case where many mistakes were made by the taxpayer, as well as discuss the appropriate methods used by MPI to valuing a minority block of stock of an operating business at various stages of the selling process. So, Mark, I'm going to turn it over to you.
Great, thank you, Pat. Again, this may seem like a very specific topic, but it is one that is extremely important, especially to business owners of family-owned businesses that maybe at some point are thinking of selling the company. Here at MPI, a lot of the valuation work that we do is for estate planning purposes. So more often than not, the lower the value, the better when making gifting or other trust transactions with your company stock. So minority blocks of stock are typically what we value on a very regular basis. And there's been a lot of chatter lately about how to value companies, private businesses that have begun the sale process. For those of you that have been through a sale of a business in the past, it's not a simple process. A lot of our clients have gone through and failed several times, whether it was on their own doing or they had a buyer drop out of the process or any number of reasons. They may have just gotten cold feet, but all this needs to be, if you're in the process of selling the company, it does need to be considered by the valuation person. So, we're seeing it very frequently where we're getting calls, often way too late in the game, where, there might be a letter of intent already signed. There still are some things that we can do. You don't just have to assume it's going to be the sale price, but it definitely needs to be considered in the valuation. Obviously, estate planning well in advance of even hiring an investment banker is always the best way to go if the objective is getting the lowest value. So that that can't replace what we're talking about here, but it comes up all the time and more frequently, especially as the baby boomer generation is starting to think about selling businesses. This concept is coming up all the time. So ultimately what we're going to talk about, and Lauren, if you want to move to the next slide, the IRS issued what's called a Chief Counsel advisory. I believe it was approximately 2 years ago. And ultimately what happened was you had a family-owned business where there were actually offers on the table at the time of making some transfers to a GRAT that I'm sure many of you are very familiar with, a grantor retained annuity trust. So again, the company was involved in negotiating with several buyers at the time, and the appraisal that they used was, I believe it was about 8 months old for a totally different purpose and didn't consider these offers that were on the table. So those are the mistakes that Pat mentioned in her opening. Those are the main things that the taxpayer can't do, and you need to consider these. So, my first question there: should a hypothetical buyer of a minority block of stock consider a potential merger or acquisition? Yes, you absolutely have to if it's a real possibility of happening. And ultimately, in the Grat transaction, because he used an outdated appraisal that didn't consider the potential merger, ultimately the Grat transaction fell apart. So that's what we're going to get into here on the next slide. Just real quick about MPI. I know I've met a number of you over the last few years of MPI being a sponsor, but we are a national consulting firm specializing in business valuation. Again, the lion's share of the work that we do is estate planning, estate tax related, dealing with private and family-owned businesses, both small as well as some of the largest privately owned companies out there, of brands that you would all know. Several of FE USA clients or I'm sorry, FE USA members are clients of ours, and how I got to know Pat and the group. We're headquartered in Princeton, New Jersey, and then we have a number of offices scattered throughout the country, as well as a number of remote clients. Remote analysts. Just scooting to the next slide. This just gives a quick slide. I'm not going to get too far into it. Just some of the other things that we do. In this presentation, I'm sure Pat will be happy to forward around to anybody. But again, estate tax, estate planning, valuation, that's our primary service offered. Then we get involved in litigation. That's for divorce, shareholder disputes, other commercial litigation. We do some M&A work, advisory work with business owners that are starting to think about the next steps. And then we also get involved in some financial reporting, valuation work after a deal has been done. So moving along, you can actually go to the next slide. So again, the IRS issued this CCA, and what exactly is a CCA? It's not a it's a document issued by the Chief Council of the IRS to basically provide some direction, provide some legal interpretation of revenue policies. It is not a it's not anything that is. It basically is providing advice to both the taxpayer and the non-taxpayer. It's not law, but it's basically just providing some advice. So this particular one, if you want to move to the next slide, this particular CCA documented a case that of a privately owned business where they made many mistakes. So it was a pretty easy case for to document in this context. So one, what are the issues? The main issue is, would a hypothetical willing buyer, willing seller, and for those of you that have gone through this before, that's ultimately the definition of fair market value. The hypothetical willing buyer, willing seller of the shares, would they consider a potential or a pending merger or sale of the company when valuing their stock? That's the biggest issue here. And again, because there was a Grat transaction, whether the donor retained a qualified annuity interest in the trust, that also was another major issue. And the answers are down below. yes, you need to consider any pending merger or acquisition of the subject company when valuing stock for gift tax purposes. And then ultimately, no, the donor did not retain a qualified annuity interest because the appraisals that they used were just outdated, and it'll be pretty obvious here when I explain. So let's move into the facts of the case. On the next page there. Okay, so we had a family operating company. They did regularly get what are called 409A valuations. For those of you that are not familiar with 409A, that is a very specific valuation that is typically gotten by the company when stock is issued as compensation, or if stock options are issued to employees, they get a 409A valuation done. However, I want to set the stage for what exactly a 409A is. It does use the same standard of value of fair market value. However, a lot of times 409A valuations, the report is very skimpy. It may or may not qualify as an appraisal for gift tax or for other tax purposes. And just to put it into context, we see a lot of 409A valuation companies that's all they do. It's a very simplistic approach. They may do a valuation for $2,000 or $3,000, where typically a valuation that we do is more like $15,000 or $20,000. So it just kind of goes into what exactly is a 409A valuation. It's typically very minimal work. It's formulaic a lot of times, where they're just punching numbers from a tax return into a calculator. That's not all the time, but for this purpose, that's the difference between the types of appraisals that are done. So they get one done on an annual basis because they did have the need for these because they were issuing stock as compensation. However, they were getting ready to do some pretty significant estate planning, and so at let's call it time zero or T, the business owners started to talk to investment banks about selling the company to a third-party buyer. The investment bank went out, started marketing the company to buyers, and some immediately expressed some interest. This was a company that could be tacked on to larger companies in their industry, so think of it as a strategic purchase. The buyers were willing to buy a minority interest with a call option to purchase control in the very near future, within a couple of years of a deal happening. So ultimately, it was a controlled deal. 6 months after hiring investment bankers, they were presented with 5 different offers, which is pretty good. A lot of times, some privately owned companies will go through the process and they come back with nothing as far as offers or real interest. There was significant interest here, and I state that for a reason. 2 days after getting these offers, the owner funded a 2-year grat with a minority block of shares in the company. And for those of you that understand the purpose of a grat, the lower the value at funding, the better. So what did they do as far as appraising the shares? They actually used the 409A valuation, which was prepared earlier in the year before they even started talking to investment bankers. So none of this was known when the 409A company did the valuation work. Obviously, it was well before any any offers were on the table, well before they even spoke with investment banks. And the reason being the 409A provided an extremely low valuation. Obviously, it doesn't consider the potential sale of the company. So that's the valuation that they use. That's mistake number one. Huge mistake to begin with. Ultimately, what they should have done is either spoken with that 409A company or come to a company like us and say, hey, we're making a estate planning transaction of minority block of stock. We're in the middle of discussions to sell the company, and they have to be upfront with everybody. And that's just clearly what they did not do here, and led to some significant problems. So moving to the next page. All right, so the third date, the company receives their final offers. One company drops out, 4 other companies provided very solid offers. And pretty soon after they did that, after they received those final offers, they made a charitable contribution, again, of a minority block of shares to a CRT, a charitable remainder trust. So for those of you that understand charitable contributions, the higher the value is typically the better. So what did the taxpayer do? They used one of the final offers as their value. They didn't use the 409A with, to be consistent. We're not talking about a long space of time here between when they funded the GRAT and when they did this charitable contribution. They were picking and choosing what they wanted to do. And, the one offer was about 3 times greater than the appraised value. So we're talking about a significant difference in value. And they were just doing it for their own benefit, picking and choosing what they wanted to do. Some of these other points on this slide are just it kind of makes it a little bit more difficult to follow. But ultimately, what we have is a taxpayer used an old 409A valuation that did not discuss where they were in the M&A process. And then for the charitable purpose, they did use one of the offers that was out there to obtain a much higher value. That's really the facts of the case that we want to get into. So let's move to the next slide and talk about what went wrong. Again, just reiterating my points. Old 409A appraisal. I'm going to talk about that in a little bit more about why 409A is not necessarily appropriate in this case. And for the GRAT contribution, I mean, how one could not consider potential sale or purchase offers for the company, that is just a huge problem, huge red flag to the IRS. Because for those of you that have gone through the process, the IRS likes to, us as appraisers, we're not supposed to use the benefit of hindsight. However, we'll tell you the IRS does it all the time. So if they know that you've gone and sold your company pretty soon after a gift transaction or a GRAT funding, they will use the benefit of hindsight. So using a 6-month-old appraisal where the facts were changing on a daily basis due to the sale merger process, huge problem. Charitable contribution using one of the offer prices. I mean, it's just the lack of consistency of the taxpayer and trying to make any kind of logical argument is just not there. So moving to the next slide. All right, so in this particular case, the estate planning tool was a GRAT. And the IRS is being much more aggressive in pursuing grats, and if they've been formed improperly or not administered correctly, I will tell you they are a target currently. So I would not try to take advantage of a grat. Listen to your counsel, listen to your advisors, and do everything the right way. Trying to save a few $1,000s by not getting the right appraisal, or not hiring the right advisors to make sure it's administered correctly. You know, when you're talking about millions of dollars of your company stock, it just really doesn't make sense. It is not worth the hassle. And ultimately, in that second bullet point there, if the IRS finds real flaws in the setup and the administration, yeah, they can collapse the whole transaction. So ultimately, what happened was the entire amount that was funded to the grat was treated as a gift, and there was a 40% undervaluation penalty. So depending on how many zeros were a part of that particular transaction, you can be talking about significant bucks involved here when you're dealing with these types of grat transactions. So moving to the next slide, just some other general takeaways that we see. One, when you have business owners that are starting to think about selling the company, the earlier you can do the estate planning, it makes everybody's job a lot easier. So if you're a business owner right now, and sale of the company is on the horizon in the next, 2 to 5 years, and you haven't done any significant estate planning of trying to get some of that company stock out of your name and into the next generation or to various trusts, the sooner the better. You can avoid this issue altogether. And an appraisal company like us can just value the company on a minority interest basis, not even having to consider the potential sale of the company. And ultimately, that's going to lead to your lowest value. The third bullet point, this is obvious, but not considering the potential sale or merger of the company in evaluation, that just leads to many problems. Ultimately, you have a taxpayer that's not being forthright with the IRS or whoever's doing the appraisal. It's tough to sneak this kind of stuff by the IRS. And it's tough to sneak by an appraisal company. We've had clients try to do that before. In fact, I had one client. We were doing a minority valuation. It was a big company. We valued the whole company on a minority interest basis around $350 million. We sent the numbers over to the attorney that hired us, and he said, "Oh, well, did the client tell you about the deal?" And we said, "What deal is that?" "Oh, well, he already has signed papers. He's getting ready to sell the company in the next couple of weeks for $600 million. So thankfully, we had an attorney that was in the know and told us about this deal, because that would have blown up in the guy's face. Our valuation wouldn't have been worth the paper it was written on, because if he's selling the company 2 weeks after we issue numbers, that's the number that the IRS is going to latch onto. So, and this is what the IRS, this is one of the most scrutinized areas that the IRS is looking at. They are looking for bad facts cases, and there's plenty of them out there. If you're following the rule, as you're doing some estate planning transactions, if you're doing everything right, you or your appraiser's not being overly aggressive with discounting and doing things like I'm suggesting here, chances are your transaction's going to get through without some major scrutiny, and you're going to accomplish generally what you're trying to accomplish. But once you start pushing the envelope and and trying to hide this kind of stuff. Remember, the IRS has 3 years after the transaction to go back and look at this. So you really need to be careful. All right, next slide, please. All right, so real quick, I want to touch on the 409A appraisals again, because this does come up pretty regularly, where I get a call and client says, hey, we get 409A appraisals, can I just use this for my gift tax valuation? And the answer is probably not. Again, I mentioned fair market value standard is used in both. However, 409A appraisals are they look different, they feel different. Does it meet the adequate disclosure requirements of the IRS for a gift tax? Probably not. Most 409A reports probably do not meet this. Adequate disclosure, your appraisal needs to meet those regulations. If not, that does not get the clock started on your gift or your estate planning transaction. Again, I just mentioned the 3 years. 3 years from the date of your gift or your transaction. If you do not meet those adequate disclosure requirements, the IRS can look at it until eternity. If you or your client dies, they can look at it at death. And even if it happened 20 years ago, and they may try to collapse that gift transaction into the estate. So adequate disclosure is probably the biggest thing you need to think about if you're starting to think about a 409A transaction, or I'm sorry, starting to use a 409A valuation in a gift transaction. And if you're not sure, the easiest thing to do, this is my last bullet point there, is just go back to the 409A company and say, hey, do you also do valuations for estate planning purposes? They may wind up with the same exact number, but if they do the estate planning work, they can reissue the report that meets adequate disclosure and really gets into everything. If they don't do it, and a lot of 409A companies do not do gift or estate tax planning work, then you should call another firm like MPI or some of the other firms out there that specialize in this. And this is what I get calls a lot of times from clients that might be in kind of niche or weird industries, and they're always concerned about, hey, have you done work in our industry? And I always say, well, what we do is not rocket science. We can figure it out, regardless of what industry you're in. We have people that can do research. If there truly are no other competitors out there, there's still ways to value companies. That's not the most important part. The most important part is, especially when you're dealing with a gift or estate tax valuation, does your company do these on a regular basis? Because, are you dealing with the IRS? We deal with the IRS every single day. We know what flies with them and what does not. If you're just hiring, a 409A guy to do your gift tax work, if they don't do it all the time, I would suggest not using them for the gift tax work, because they won't know how to write the report, and they probably won't meet the adequate disclosure requirements. All right, I think that's enough on 409A. So let's move to the next slide. How does the IRS view potential sale and mergers? I point out, there's a number of cases that are out there that the CCA points to. Colesman, Trust Services of America, and Guilford. Ultimately, what is said here with each of those cases, post-valuation date events can be considered if it was reasonably foreseen or uh, or if it was knowable as of your valuation date. So obviously, if the sale of a company hasn't occurred yet on your valuation date, uh, obviously it hasn't occurred yet, or we wouldn't be talking about owning the stock. So uh, it hasn't occurred yet, but if you're at various stages of negotiating to sell your company, you would consider that as you're buying that stock on that valuation date. You would want to know, okay, uh, they're dealing with 5 potential buyers right now. All of the prices are within 5% of each other. They're all very strong buyers. They've done this before. Chances are a deal is going to close with one of those buyers. So you need to very importantly consider what's going on uh, there with that potential deal. Let's talk about another case. All right, I just hired an investment bank. They haven't even gone to market yet. I've done this 3 other times over the years. I failed every time. 2 times I got cold feet. Another time a buyer bailed out, during the process because they didn't like our financials. So in that case, how much do you really need to consider what's going on? Yeah, you need to mention it in your report as an appraiser. But am I willing to say, hey, this is 99% sure that this deal is going to close? Probably not. It's still early on in the process. We don't even know if there's any buyers that might be interested. But you really need to try to put blinders on as of your valuation date. That is what is so important. So, in fact, I just got off the phone with somebody that said they were considering making a gift prior to selling their business, and I said, have the client start taking notes on the process that they've gone through. What date did they start talking to investment bankers? What date did they hire investment bankers? When did they get initial offers? All that is important because that's what the appraisal firm needs to do. We create a timeline, and ultimately that's what the IRS is going to do. So keeping historical notes on that, it's a lot easier these days with emails and things like that. But keeping track of the timeline is most important. So anyway, these cases, tax court cases that the CCA brings up, ultimately it does say you need to consider, you can consider post-valuation date events if it was reasonably knowable on your valuation date. So let's move to the next slide. So I want to talk a little bit about what we do at MPI. Generally, we agreed with everything that came out of this CCA. So I'll explain our approach a little bit. We always start all of our valuation engagements of operating companies with a thorough due diligence process. We do our own research, and then we sit down with business owners for 2 or 3 hours. We prefer to do it on site. And we ask a lot of questions just about the company's operations, and then we start to get into some other issues. Yeah. Have you ever been approached to sell the company? Have you ever talked to investment bankers? All that type of stuff. That is what needs to be asked during this process. Business owners can, we can see them start squirming sometimes, but everything that we do is totally private. The only one that sees it is the client, their advisors, and the IRS. Nothing is made public of what we do or really any valuation firm. But it's all relevant questions that we need to ask if we're going to be putting together a valuation. So if we learn that the company has started some sort of M&A process, again, we start to nail down the timeline. We will ask for we may ask for email communication with investment bankers. You know, if they've gotten to the point where they put together an investment banking deck or any kind of board package, financial projections. And then, you know, we start talking about indications of interest, IOIs, or letters of intent, LOIs. We ask for all that type of stuff. If none of that has been produced yet, okay, it sounds like you're very early on in the process. But, you know, if you have a signed letter of intent that somebody is willing to, somebody is starting their own diligence process, or maybe in the middle of a diligence process, we need to know about that because that does dictate how we go about our valuation. So there at the bottom, and there's slight variations of each one of these, but for the most part, these are the four levels of M&A negotiation that you know that we consider. One, nothing is going on. Business owner doesn't have any interest. We just value it as a private company without any real potential for an M&A transaction. Two, sale of the company is the goal. They've started, probably hired investment bankers or some sort of advisors, but they're early on in the process. And then 3 and 4, investment bankers have been hired and various stages of negotiations, whether they've received IOIs or LOIs. And again, you can be at various variations of each one of these. Like if you have a company that has a signed letter of intent, have they started diligence or have they not? You know, we've had some where they've completed diligence and, you know, they're 2 weeks away from the deal actually closing and they're just waiting for some, you know, rubber stamp regulatory approval. We have some other ones where they haven't begun diligence yet and they have some real concerns, you know, about what the potential buyer is going to find. You know, that's a big difference than, you know, just a rubber stamp regulatory approval. So there's all different variations, but we go through the diligence of finding out where they are because that dictates how we go about valuing it. So the next page. So how does MPI? What exactly do we do? All right. So for the first outcome, private ownership, not considering any M&A activity. Again, we are valuing a minority block for, let's say, gift tax purposes. We value it as is with all normal discounts for lack of control and lack of marketability. That one's very simple. For the second outcome that we mentioned, maybe they just started to talk to investment bankers. Typically what we do is we'll value the company 2 different ways. Value the company as is on a privately owned basis with full discounts. And then a second scenario where we value with the company on an M&A approach, and what's the most likely value to come out of that M&A transaction. And then what you do is you place weights on each scenario. And this is a totally subjective call by the appraiser, but we ask a lot of annoying questions to try to get to what are these weights. Again, if it's a toss-up, you may go 50-50. If they've just hired investment bankers, but they're not even sure if they really want to do it, they don't know what kind of price they're going to get, all those types of things, then maybe it's a 90-10, maybe it's 20-80, something like that. But in our opinion, if a minority investor is coming in during this process, this is the type of analysis that they would do. What's the likelihood that this deal could actually close? and what price would it be at. For the third outcome, where they've already gone out, marketed the company to a number of firms, and they've received some IOIs. If there's a high number of IOIs and it looks like this is a real viable company that could be sold. All right, then maybe you're starting to talk about, ratcheting up those weights that we mentioned previously, to higher on the M&A side. And you're getting more clarity on the M&A side because perhaps they've started talking about, the actual sale price of the company. And then finally for LOIs, where you have a signed LOI, or the closer you get to the end of the process, you may drop the first valuation of a as is on a privately owned basis, and you may only consider your potential sale price. But what you do is there's still what we call a merger arbitrage discount, which can be somewhere between 1% to 10% usually, and this accounts for the possibility of the deal falling through. We have a bunch of data that we have put together of public deals, and the pricing of stock prices of public companies as they approach the potential sale date, just to get a sense of what that underlying discount would be. So again, the ultimate discount that from your sale price, if you think about it, the closer you get to your deal actually occurring, that discount keeps shrinking and shrinking. For an as is privately owned company on a minority interest basis, we say the typical discount, if there's no M&A activity going on, usually that's somewhere between 30 and 50%, the all-in discount. And again, that depends on a number of factors. Are there add backs for compensation, all that kind of stuff that is not appropriate for this call, but it's a big discount. It certainly is a big discount. And the closer you get, the more milestones that you hit that I keep mentioning. Hiring the investment banker, they put the book together, they started marketing the company, they've received IOIs and ultimately LOIs. Each one of those milestones, that discount keeps shrinking. It's difficult for me to say, it's not just written in stone that, okay, you receive an IOI, you're looking at a 20% discount. Everything is very fact specific. But let's say if you had a company where the all-in discount was say 35%, and like I mentioned before, the one extreme, 35%, and then your other extreme is say 2%, your merger arbitrage discount, because they're only a couple weeks away from the deal closing. In between there, it just kind of goes, on a straight line. You're reducing your discount the closer and closer you get. So I didn't want to get too far into doing math and all that type of stuff, but this is how an evaluation firm goes through it. In our opinion, it's the way that a minority investor would consider how to value a minority block when the company is negotiating a potential sale. So hopefully this has given you a lot to think about. Yes, Pat.
Yeah, so I was going to say, so let's take off from that with some of the questions that were submitted online when people registered for this. And one of them revolves around, can you have different classes of stock with the minority blocks? And maybe you can talk about some of those classes of stock might be non-voting versus voting.
Sure. Yes. So certainly, when you're talking about a minority block of stock, You can have a minority block of voting stock. You know, if there's 100 shares of voting stock and you only have 40%, that's great that you have voting stock, but you don't necessarily have control of the company. Your traditional discounts for minority and marketability will apply to that particular block. That being said, all else being equal, you would rather hold a minority block of voting stock versus a minority block of non-voting stock. So there still is an additional discount between minority voting and minority non-voting. In our experience, it's pretty minimal. It's usually somewhere between 1% and 5%. So yes, there is somewhat of an additional discount for non-voting stock versus voting stock when you're talking about minority blocks.
And you can have different kinds of stock holdings and ownership within that valuation process that you're going through. So you may have different valuations, correct?
Yeah, absolutely. I mean, it's kind of crazy to when you hear me say this, but yes, if you're valuing a company, you can have different values on the same date for a company, and that's primarily due to minority versus control. You know, your control value, if you had, you know, full control of the company, you know, that's worth 100. If on same date, same fact pattern, but the company's not going through a sale process, you know, that company on a minority interest basis is worth only 65. So yes, it just depends on what exactly the stock holding interest is being valued. So yes, you can have different values.
So I'd like everyone to know that you can put questions in the Q&A in the chat. We have some time left. We had left time for questions. I have a question for you, Mark, that I think a lot of people have asked me over the years, and that is, let's take an example of a family business that likes to gift a certain amount of stock away every year, maybe to the grandchildren, next generation. So in order to do that, they need a valuation. How often do they need a new valuation every single year? Can they do it every other year? How often do they need to have that valuation done?
Sure. Yeah, great question. And I probably get that once every other week. So there's nothing black and white out there that's ever been issued by the IRS. That being said, if you're making gifts on an annual basis, or gifts are being made throughout the year, I do think evaluation of at least once a year probably makes sense. Again, that's if transactions are being made. If there's no transactions, you don't need to get a valuation done. But you know, if it is done somewhat regularly, at least annually, I do think you should get it once a year. At least once a year. If you have a company that is in high growth or in decline at a rapid pace, that probably needs to be done even more than that, because, you know, as you know, or there's been a major change, like I described earlier, to the company. You know, let's talk about, you know, 9/11 or COVID. You know, if you got a valuation done before one of those events and you're making a gift 6 months after, it's a totally different company. It's a totally different world. You really can't be using something before that. So yeah, high growth or extremely companies that are going into the tank, or if there's been major events with the company or in the world, you probably need to do it a bit more often.
So what about valuing a private company? You talked about your methodology, which I think is very helpful, and how you value it at different stages, different weights based on ownership, based on this, where the company is in the event they're involved in a transaction. But what is the most challenging part of valuing a private company?
Yeah. We here at MPI, we are a big fan of the market approach. The market approach is where you try to find what we call guideline companies, whether they're publicly traded or they've been recently sold, to look at and compare to your company to try to find what is the valuation multiple that I should be applying to our particular company, and finding good quality. I don't use the word comparable. That's a real estate term, and it's frowned upon using in business valuation for various reasons. But finding good companies that are, can be used as guideline companies to compare to your private business, that's probably the hardest thing out there. Because if you think about it, a lot of the private companies that we do may be between somewhere, 50 to 100 million in revenue. Most public companies are much larger than that. They just have different magnitude of operations because they are so much larger. I would say that's probably the hardest because, in our opinion, the market approach provides provides what people are actually paying for companies, as opposed to a more theoretical discounted future cash flow analysis or an income-based approach. We'd like to sink our teeth into actual transactions that are happening, and trying to find those transactions can be really difficult sometimes, just because whether the company, what they do is so unique, or just size differences just doesn't make it realistic to find a good comparable company.
That's very helpful. So we have a few minutes left. So this is my last question for you, Mark. And again, this was come from one of the people that registered. Is there a discount for a minority share, a 1/3 share of an LLC that holds only real estate?
Yes, absolutely. And we do, other than just operating companies, which we've talked about a lot today, a lot of the work that we do is of, family holding companies that hold either real estate or different types of investments, meaning securities, private equity securities, or even marketable securities, publicly traded stocks or bonds. But yes, if you have one of these family holding LLCs that owns real estate, it can be whatever. It could be vacant land. It could be a strip mall somewhere. If you're talking about a 33% interest, assuming that is a non-managing, non-controlling interest, yes, that there's absolutely a discount that applies. For real estate LLCs, we typically see discounts 35-40%. For LLCs that own more like marketable securities, stocks and bonds, that discount comes down a little bit. That's probably more like 25 to 30%. But yes, we see discounts like that all the time.
We have, again, just a couple minutes left, but we have a question that popped up from Rob Hutchins, and I'm going to read it to you, Mark, and hopefully you can answer it in the time we have remaining. How do you reconcile the difference between financial valuation for gift and estate tax purposes to the strategic valuation that could be the basis for an M&A potential transaction?
I think the best way to answer that, and I'm happy to discuss this over the phone if my answer doesn't make sense or doesn't address exactly what you're looking for, but you don't necessarily have to bring those two values back together. So I believe what he's asking is, okay, you have a strategic value of your company. If you were to go and try to sell your company to a competitor, somebody that is willing to pay, a good premium and just bolt your company onto their company. And the financial value of a minority based valuation. You don't necessarily have to if the company is not up for sale. So, if we're told by the business owner, hey, we have no desire to sell this business, I'm passing it to the next generation. They hope that they're going to hold on to it for the next 20 years. You don't necessarily have to know what that strategic value is. It's just almost irrelevant. If the facts were opposite and they were looking to sell the company in the near future, like we talked about, then yes, you do have to bring the two values back together. But pure minority, privately owned, no M&A activity in the future, I would say you don't necessarily need to know what the strategic value is.
Yeah, that's a great answer. Thanks so much for that, Mark. And thank you for being on this webinar. We really appreciate the wonderful presentation that you've delivered today. I know everyone on the call really enjoyed it as much as I did. So thanks again, Mark. Thank you, everyone, for joining us today and for your time. I hope you all have a great rest of your week. Take care.